Tonight may be Judgment Day for the AI trade. Over the past 4 weeks, the S&P 500 has surged. Nvidia, Alphabet, and Meta have each bounced more than 25% from their recent lows. So the question investors are asking is simple. Is the AI bull market back? But before you get comfortable, there is one major problem. Wall Street may have already pushed expectations straight into the danger zone. This week, roughly $16 trillion in big tech market value moves into the earnings spotlight. And the question is no longer just whether these companies can beat estimates. The question is whether this is the next leg higher for the AI rally, or a perfectly timed setup for retail investors to buy near the top. And the answer comes down to one thing. Not revenue, not adjusted earnings, not another polished AI demo. Wall Street wants to know whether artificial intelligence is finally turning into real cash flow. Because after a rally this sharp, good is no longer good enough. If cloud growth slows, even slightly, if AI spending keeps climbing, or if management cannot clearly explain when those investments start paying off, this market could punish these stocks quickly. And earnings are not the only risk. Right behind them, investors are also facing Jerome Powell, PCE inflation, and oil prices tied to Middle East tensions. So this market is not running on an open road. It is dancing between 3 barrels of gasoline. If you own the Magnificent 7 semiconductor stocks, or you're thinking about buying the dip, this week matters. So let's break down what Wall Street is really watching. First, understand why the bar is so high this time. This is not a normal earnings week. The market has already front-run part of the answer. TechStocks have pushed the indexes higher. Sentiment has recovered. Valuations have repaired. In other words, a lot of good news may already be priced in. And that changes the entire game. When a stock is beaten down, earnings can be a catalyst. But after a 20% or 25% rally, earnings become a test. A company cannot simply beat estimates by a small margin and expect investors to celebrate. It has to prove that the current valuation is justified. That is the brutal part of this market. It is not asking whether Microsoft is a great company. Of course it is. It is not asking whether Google, Amazon, Meta, or Apple are profitable businesses. Of course they are. The real question is this. Are they good enough to support the prices investors are already paying today? That is why this week is dangerous. Cloud growth has to be strong. Margins have to hold. AI spending has to sound disciplined. Free cash flow cannot look weak. And guidance has to convince Wall Street that the second half of the year still has momentum. If even one piece of that story breaks, institutions may use earnings as a reason to take profits. And that is where retail investors need to be careful. The most dangerous setup is not always bad earnings. Sometimes the most dangerous setup is good earnings that were already priced in. That is how investors lose money in great companies. They buy excellent businesses at moments when the stock has already discounted the next wave of good news. Microsoft is still Microsoft. Google is still Google. Nvidia is still Nvidia. But if the price has already pulled future optimism into the present, earnings can stop being a catalyst and turn into a profit-taking event. So what is Wall Street really watching? The answer is AI monetization. For the last year, the market rewarded companies just for being connected to AI. If you were building data centers, buying GPUs, training large language models, or launching AI products, investors gave you the benefit of the doubt. But that phase is ending. The market is moving from imagination to proof. A year ago, the question was, do you have an AI strategy? Now the question is your AI strategy making money? The first place to look is cloud growth. Microsoft Azure, Amazon AWS, and Google Cloud are the clearest windows into real enterprise AI demand. If companies are actually paying for AI tools, buying compute capacity, and scaling AI workloads, it should show up in cloud revenue. If cloud growth stays strong, investors will believe the AI demand cycle is still intact. But if cloud growth slows, even slightly, Wall Street will start asking whether the AI boom has been overhyped. The second thing to watch is capital spending. Big tech is spending aggressively on data centers, chips, power, and AI infrastructure. That sounds impressive, but investors are becoming much more focused on one question. How long will it take before this spending turns into returns? AI infrastructure is not free. Every extra $1 billion spent on servers and GPUs can pressure short-term cash flow. And that brings us to the third key metric, free cash flow. Revenue can tell a story. Adjusted earnings can be managed. But cash flow is much harder to hide. If AI keeps consuming cash without a clear return, valuations may have to be recalculated. And finally, guidance matters more than the quarter that just ended. Earnings tell us what happened. Guidance tells us what management sees coming next. Wall Street wants to hear that cloud demand is still strong, that AI adoption is accelerating, that margins are under control, and that capital spending is not becoming a bottomless pit. So the key word this week is not AI. It is cash flow. The first half of the AI trade was about imagination. The second half is about monetization. Now let's look at the companies. Microsoft is the first major test. This is no longer just a software company. Microsoft is the market's cleanest test of whether enterprise AI can become a real paid product. Investors will be watching Azure growth, Copilot adoption, and AI infrastructure spending. The risk for Microsoft is not that it lacks AI credibility. The risk is that expectations are already extremely high. If Azure comes in even a little light, or if management sounds vague about AI returns, the stock could react much more sharply than the headline numbers suggest. Amazon is a different test. For Amazon, the real story is not e-commerce. It is AWS. AWS has to prove that enterprise AI demand is still strong. Amazon is spending heavily across retail, logistics, cloud, and AI infrastructure. So Wall Street needs evidence that this spending is not just building capacity, but creating future cash flow. If AWS growth disappoints and free cash flow comes under pressure, investors may start questioning whether the AI payback period is simply too long. Alphabet is facing an AI defense test. Google has to prove three things at once. Google Cloud is still gaining momentum. Search advertising is not being disrupted by AI. And Gemini is more than just a product demo. Google's problem is not technology. It is trust. The market keeps asking whether AI could eventually weaken the search business, which is still Google's profit engine. If cloud is strong, ads are stable, and AI progress looks real, Alphabet can continue its valuation recovery. But if any of those pieces wobble, investors may quickly put the AI laggard label back on the stock. Meta's test is about discipline. Meta has a huge advantage. Its advertising machine still generates enormous cash, but it also has a major risk. Investors remember how much money the company burned on the metaverse. So this time, Wall Street is watching two things very closely: ad growth and AI spending. Meta can invest heavily in AI, but investors do not want another open-ended spending story. If Mark Zuckerberg sounds too excited about AI infrastructure, while margins and cash flow start to weaken, the market may immediately remember the metaverse era. Apple is the most unique case. Apple is not the core cloud AI player in this group, but it matters because it represents consumer tech confidence. Investors will be watching iPhone demand, China, services revenue, and most importantly, whether Apple can give the market a clearer AI roadmap. Apple's issue is not just whether the quarter is good or bad. The bigger question is whether investors still believe Apple can catch up in the AI race. If guidance is weak, Apple could drag down broader tech sentiment. But if expectations are low and Apple delivers a more convincing AI story, it could become a surprise rebound candidate. So these companies are not all taking the same test. Microsoft is testing AI monetization. Amazon is testing cloud demand. Alphabet is testing its search mode. Meta is testing spending discipline. Apple is testing whether it still deserves AI optionality. And whichever company gives the weakest answer may be the first one Wall Street sells. But here is the bigger issue. Even if big tech delivers solid earnings, the market is not automatically safe. Because this week is not just about earnings. It is earnings plus macro pressure. A company's results determine whether the story is still strong. Interest rates determine how much that story is worth. And right now, there are three macro risks sitting behind this market. The first is Powell. If the Fed holds rates steady, that alone may not shock anyone. The real issue is Powell's tone. If he sounds even slightly hawkish, if he suggests inflation is still sticky, or if markets push rate cut expectations further out, high valuation tech stocks could feel immediate pressure. The second risk is PCE inflation. PCE is one of the Fed's preferred inflation gauges. If it shows inflation is not cooling fast enough, the market may have to rethink the timing of rate cuts. And when rate cuts move further away, expensive growth stocks become harder to justify. The third risk is oil. A lot of investors think oil only matters for energy stocks. That is a mistake. If Middle East tensions push oil prices higher, inflation expectations can rise again. That feeds back into rates, and higher rates can pressure tech valuations. So this week has multiple pressure points. Strong earnings with bad macro may not be enough. Average earnings with bad macro could trigger a much bigger pullback. And if oil, inflation, and the Fed all move against the market at the same time, even strong AI numbers may not save tech from valuation reset. That is why investors need to think in scenarios, not predictions. Scenario 1 is the bullish case. Big tech reports strong numbers. Cloud growth accelerates. Guidance is confident. And AI spending starts to look like it is producing real returns. If that happens, tech could continue leading the market higher, and the S&P 500 could keep pushing toward new highs. But even in that scenario, that does not mean you chase blindly. The market has already moved a lot. In a strong trend, discipline matters even more. Strength is not a reason to buy at any price. Strength is a reason to wait for confirmation and better entries. Scenario 2 is the neutral case. Earnings are fine. Revenue is okay. Profits are okay. There are no major disasters. But the numbers are not spectacular. This is the scenario that can hurt retail investors most. Because on paper, the earnings may look solid, but the stocks may still fall. Why? Because the market was not priced for fine. It was priced for excellent. When expectations are already high, a decent quarter can trade like a disappointment. Scenario 3 is the bearish case. Cloud growth slows. AIStocks keeps rising. Free cash flow gets pressured. Management gives cautious guidance. If that happens, Wall Street will not be patient. The stocks that rallied the most could get hit the hardest. Money could rotate out of high-valuation AI names and into defensive sectors, energy, or companies with more stable cash flow. And for retail investors, the worst move in that scenario is rushing to buy the first red candle. The best opportunities usually do not come on the first drop. They come after expectations have been reset. So what should investors actually do this week? The answer is not panic selling, and it is not blindly chasing. The answer is controlling your timing. The most expensive mistake right now is confusing FOMO with opportunity. First, be very careful about buying stocks that have already rallied sharply into earnings. If you were afraid to buy them lower, but suddenly feel confident after a 20% or 25% move, ask yourself what changed. Are you seeing new information, or are you reacting to price? Second, wait for the market's first reaction to settle. An after-hour spike does not always confirm a breakout. Sometimes it is just emotion. An after-hours drop does not always mean the company is broken. Sometimes it just means expectations were too high. The real signal often comes the next day, or even the day after that. Once volume, institutional positioning, and the broader market reaction become clearer. Third, focus on 3 confirmation signals: cloud growth, AI spending discipline, and free cash flow improvement. If those 3 are not there, be careful declaring that the AI bull market is fully back. You can believe in AI without chasing every AI stock at the hottest moment. Experienced investors do not need to buy when everyone else is emotional. They wait for the market to show its hand. Because this week is not just about whether one company goes up or down after earnings. This week could tell us where the entire AI trade stands in its cycle. For the past year, investors were willing to pay for the dream. More compute, more chips, more data centers, more AI products, more long-term potential. But now Wall Street is asking a much harder question. Can AI actually produce cash? If big tech proves that cloud growth is strong, margins are stable, CapEx is manageable, and AI is turning into real revenue, then the second stage of the AI bull market may be confirmed. But if growth slows, spending keeps rising, and cash flow gets squeezed, this rally may turn out to be a very expensive trap for late buyers. AI will not disappear because of one earnings season, but a lot of investors' profits can disappear because of one badly timed chase. So the real test this week is not whether you understand that AI matters. The real test is whether you can stay disciplined when everyone else is getting excited. Now I want to know what you think. After big tech reports, does the market break out again, or do we get a pullback from these levels? Comment 1 if you think the rally continues. Comment 2 if you think this is a bull trap. Comment 3 if you think we sell off first, then get a better buying opportunity later. And if you want a company-by-company breakdown of Microsoft, Amazon, Alphabet, Meta, and Apple, make sure to follow along. Because this is not just another earnings week. This is a pressure test for the entire AI trade.